Welcome to the deep dive. Okay, let's unpack this. Have you ever looked at a company report, or maybe even just your own team's metrics, and sort of wondered, is this really telling the full story? Today, we're diving into the fascinating world of performance reports. We've got some really great sources that cut straight to the core of how to truly figure out if these vital documents are actually hitting their mark.
Yeah, doing what they're supposed to do.
Exactly. Our mission here is to give you the insights to understand what makes a performance report effective, impactful, and genuinely useful, not just a pile of numbers.
And what's fascinating here, I think, is that despite how common performance reports are, there's certainly no single correct way of measuring or presenting performance.
Right.
It really does depend on the organization's purpose and, crucially, its audience. Who's it for?
So, okay, if we're serious about evaluating these reports, where do we even begin? Our sources suggest starting with something pretty fundamental, but maybe surprisingly easy to miss. Does the report actually reflect what the organization is truly trying to achieve? Its core mission and objectives.
Exactly. That's the starting point. An organization's mission defines its fundamental purpose. A good report must address the extent to which that purpose is being measured.
Makes sense.
So take a Kilty, for example, a company mentioned in one of our sources. Their mission is to deliver long-term returns to shareholders through a combination of sustainable growth in earnings per share and payment of cash dividend.
Okay, so two parts there.
Right, two distinct parts. And a comprehensive report needs to make sure both of those components are being adequately measured. If a mission has multiple facets like that, the report really needs to speak to each one.
Okay, so once we've kind of nailed the big picture, the mission, what about those more specific goals, the ones that sit underneath?
Well, after the mission, you then look at the subsidiary aims. These are the more granular objectives that help achieve that big mission. So for a Kilty, their subsidiary objectives include things like improving product ranges, increasing the number of customers and how much they spend, focusing on customer service, and improving profitability through efficient cost control, specifically in purchasing and inventory management.
So quite a few specifics.
Yes, and the report needs to measure each of these key areas effectively. And this isn't just about spotting a gap, like saying, oh, something's missing.
Right.
It's about connecting the dots.
Right.
If a report, say, is missing information on inventory, it's not enough to just point that out.
You need this so what?
Precisely. The insight comes when you explain why that matters. Maybe without it, management is completely blind to the hidden costs of obsolescence or waste.
Okay.
That why transforms a simple observation into something actionable. It reveals the true cost of what's not being measured. Our source actually gives a good example of how to articulate this. Yeah, it says, just pointing out, say, that the fourth subsidiary aim is only being measured through gross profit margin, and there is nothing on inventory. Might get you some credit, like 1 mark in an exam context.
Okay, basic observation.
What if you add the why, and there's nothing on inventory, which would be useful as it could measure how much obsolescence and inventory write-offs were costing a Kilty. That's where you get the deeper understanding, the second mark. The justification is vital.
That makes perfect sense. Okay, so beyond the actual content, what's being measured, how it's presented seems equally crucial. I mean, if the best information is buried, it's basically useless, right?
Absolutely.
Yeah.
Completely useless. And the audience for performance reports can vary so widely. You've got the board of directors, maybe executive leadership, team managers.
Well, there are sometimes government bodies.
Exactly. Owners, government, those charged with governance. So it's vital to assess the appropriate level of detail, the layout, even the terminology used.
You have to tailor it.
You do. You need to ensure the users will properly understand and, importantly, act on the information provided, not just skim it.
And one of the most common criticisms, I think our sources really highlight this, is just too much information. Reports get cluttered. They're almost impossible to really interpret quickly.
Oh, that's a huge one, a really common pitfall. Too much information can actually, as one source puts it, obfuscate the facts and blunt the message.
Obfuscate, yeah. Makes it harder to see the truth.
Precisely. Think about it. A report for the board should be focusing on strategic performance indicators, those high-level insights. They probably don't need to get bogged down in every single operational detail.
If you need the helicopter view.
Right. And the layout itself, the design, must help users quickly see the important amounts, the trends, the key results, and graphical displays.
Charts and graphs.
Yes. A well-designed chart or infographic can truly make complex data digestible almost instantly. It transforms those raw numbers into immediate understanding.
But what about the story behind the numbers? Because, a string of figures, no matter how pretty the chart looks, doesn't really tell us why something happened.
That's where narrative commentary comes in.
Yeah.
It's absolutely necessary. You need to explain the significance and the causes of specific outcomes.
Like an example.
Okay, so say there's an adverse material price variance. Fancy term, but it just means your raw materials cost more than you expected.
Right.
The report needs to explain why. Was it a supply chain issue? Did you switch suppliers? Maybe global events impacted prices.
So giving context.
Exactly. Providing an explanation for how something arose avoids a load of follow-up questions later and really helps the recipient understand the situation properly.
Yeah.
It gives context to the data.
Okay, so we've talked about what's in the report and how it looks. But beyond the current numbers, it often feels like there are crucial pieces of context or comparison missing, things that would make a report truly robust. What are some of those critical gaps you typically see, and why are they so indispensable?
You're spot on. Really important missing information often includes things like external benchmarks.
Competitor data.
Yeah, competitor information. How are we actually doing compared to the industry average or our key rivals? Also, previous year's data.
Yeah.
You need that for trend analysis.
Absolutely. Is this number good or bad compared to what?
Exactly. Without looking back, you don't know if a figure is just a one-off blip or part of a consistent pattern, good or bad. And budget information, of course. Performance against planned targets is pretty fundamental.
Yeah, can't manage without that.
But again, echoing what we said earlier, it's not enough just to state what should be included. You absolutely must justify why including this information would be useful to this specific organization. That justification, that tailored relevance, is what truly sets a high-quality evaluation apart.
Okay, so what does this all mean for how we think about performance itself? We often fall into the trap, don't we, of thinking about performance purely in financial terms, dollars and cents. But our sources strongly suggest that's, well, a mistake. Why is that?
It's a really critical distinction to make. Information, generally speaking, can be classified in a few ways. Let's break it down.
Okay.
First, you have financial information. These are your familiar numbers, sales, profits, costs, but also maybe more specific metrics like gross profit percentage.
Which tells you how much you keep from sales after cost of goods.
Right. Or return on capital employed, showing how effectively a company is using its investments, its capital, to generate profit. Standard stuff, mostly. Then you have non-financial quantitative information. This includes things you can count but aren't directly about money, like the percentage of product rejects coming off a production line, maybe the sheer volume of sales or the number of customer complaints received. Still numbers, but not currency.
Okay, countable but not financial.
Exactly.
Okay.
And then the third category, non-financial qualitative. Now, this category covers those more intangible aspects, things like the company's reputation, its overall effectiveness in its field, customer satisfaction levels, staff morale, the level of innovation.
The fuzzier stuff.
You could say that, yeah. The stuff that's harder to put a precise number on. And here's the crucial insight. Non-financial performance is actually a very important determinant of long-term success.
More important than short-term financials sometimes.
Often, yes. Think about it.
Yeah.
Short-term financial performance can often be artificially boosted, can't it? Maybe by reducing quality control, cutting back on innovation spending, or scaling back on staff training.
Squeezing costs today.
Exactly. But a business that pursues those approaches is almost certainly going to suffer financially in the long term. Customers leave, products become outdated, skilled staff depart.
Right, the chickens come home to roost.
Precisely. So, for instance, a manufacturer known for high quality needs to monitor product quality meticulously. That's non-financial, but vital. Whereas for maybe a cheap and cheerful discount supplier, the cost per unit might be far more critical.
Different priorities.
Different priorities, different non-financial metrics matter more. And think about not-for-profit organizations too. For them, non-financial performance, like the impact on the community or patient well-being in a hospital, that's often the primary goal, the end in itself, not just a means to profitability.
That makes a lot of sense. But measuring things like reputation or staff morale, that sounds incredibly tricky. How do organizations even begin to do that when these things feel so intangible?
You're right, it is tricky. Non-financial qualitative information is much harder to measure objectively. We're often talking about what academics call a construct.
A construct.
Yeah, basically an attribute or quality that you can't measure directly with a standard tool like enthusiasm or empathy or maybe brand perception. These things are really crucial in business, but you can't exactly, put a thermometer on enthusiasm.
No, not really.
So usually for communication and assessment purposes, an effort has to be made to somehow turn that qualitative information into quantified information, something you can track.
Try and put a number on it.
Essentially, yes. For example, in a hospital setting, patients feeling like they were treated sensitively and with dignity is absolutely vital, right? That's qualitative.
Very important, yeah.
So management might set up some type of numerical assessment system to try and quantify this. Maybe through patient satisfaction surveys with specific questions rated on a scale, 1 to 5, so that what was qualitative becomes something measurable, a target maybe.
This raises a really important question, though. If we try to put a number on something that's fundamentally intangible, like dignity or enthusiasm, are we truly capturing its essence? Or are we maybe losing something important in the translation?
That's a sharp insight and exactly the challenge. That's the potential pitfall. The transition from qualitative to quantitative can indeed introduce distortions.
Distortions? How so?
Well, what ends up being measured might not truly reflect the underlying construct the organization actually wants to assess. The metric might become a poor proxy for the real thing. Our source gives a really vivid example, actually. It talks about trying to measure enthusiasm. An organization might decide to measure, say, what time staff arrive in the morning. Seems logical, maybe. Early equals enthusiasm.
I can see the thinking, yeah.
But the person who always arrives 40 minutes early might simply be, as the source puts it, a victim of an hourly train service. They have to arrive 40 minutes early or be 20 minutes late. It might have absolutely nothing to do with their actual enthusiasm for the job.
Right. That's a perfect illustration. The chosen metric completely misrepresents the reality and measures train schedules, not enthusiasm.
Exactly. So you have to be incredibly careful when quantifying the qualitative. The metric might create unintended consequences or just be wrong.
Wow. Okay. So wrapping this up, what have we really learned about cracking the code of these performance reports? It seems like the journey always starts by aligning with that North Star, the organization's mission.
Definitely thoughts there.
Then you zero in on those crucial specific goals, the subsidiary aims. And finally, you really have to scrutinize the craft of the report itself. Is it clear? Is it compelling? Is it actually telling the true story, both financial and non-financial?
That's a great summary. And if we connect this to the bigger picture, just remember that this kind of structured approach, mission, aims, presentation, justification, it's key to keeping your own analysis organized and truly identifying what's most important.
Right.
And crucially, never be afraid to recommend changes or alternative to how things are measured or reported. As long as, and this is the key bit, your recommendations are fully justified with a clear why behind them. Why would this change be useful? Why does this missing piece matter? Without that crucial context, as you said earlier, the numbers are just numbers.
So maybe as you go about your day, perhaps consider the reports you encounter, whether they're for a huge corporation, a small team project, maybe even your own personal goals you're tracking. Ask yourself, are they really measuring what truly matters? And especially for those intangible, qualitative aspects of performance, things like morale or innovation or customer relationships, how could we truly understand their impact without accidentally distorting their profound meaning when we try to slap a number on them? It's definitely something to mull over.